So, hello and welcome again to my channel where I translate technical accounting lessons to a storytelling version, sort of. And today, we are going to answer this question. What if you wrote something like this? Like, I, Baby G, promised to pay Papa G 1 million to be paid as follows. So on 12/31/20x1, you are to pay 300,000, and on 12/31/20x2, you are to pay 400,000, and lastly, on 12/31/20x3, you have to pay 300,000. Okay? Plus 10% interest rate based on the outstanding balance. Meaning, you have to pay at the end of the first year this 300,000 plus 10% based on the beginning balance of your liability in year 1. Okay? And that's 1 million times 10% equals 100,000 interest. So in year 1, you have to pay 300,000 plus 100,000 interest or 400,000. Okay? So that's the meaning of this phrase or this statement. Now, moving forward, in year 2, since the outstanding balance will now be 700,000. Why? Because the 300,000 was already paid at year 1. So 10% times 700,000 equals 70,000 as the interest for year 2. So, at the end of year 2, you are to pay 400,000 plus 70,000 interest or 470,000. Okay? And lastly, at the end of the third year, you are to pay interest of 10% based on the outstanding balance of 300,000 only already. Okay? Because from 1 million, the 300,000 principal has already been settled in the first year. And the 400,000 has already been paid in the second year. So, 1 million minus these two payments and we have 300,000 as the remaining or the outstanding balance only. Okay? So, let's multiply that with 10% and that will be 30,000 plus the principal payment and we have 330,000 as your last payment. So again, that's the effect of this statement or phrase. Okay? And again, what if you wrote this? What will be the accounting problem? Let's talk about that after this. So, before we go to the accounting of this instrument, let me add something. Okay? So, what if you executed this promissory note because you bought this flying car and you don't have any money to pay yet? Well, first of all, this instrument that you wrote or that you have written is what do we call an interest-bearing note. Why? Because of this statement here. Okay? Now, the accounting for these notes payable is not complicated at all because you just have to treat this 1 million or the sum of these three principal payments as the initial value of your liability because it is already the present value of your liability. Because in these three principal payments, interest was not included already. And because of that, discounting is already not necessary. Again, you don't need to discount. It is because this 3 here is already presented at present value. And in fact, the interest is not included in this. Okay? So, if we talk about measurement, you can make already an amortization table or in my case, a timeline that will start at 1 million times 1.10. Yes, this is already the effective rate, this here in this promissory note. And we will get 1,100,000 minus the principal payment of 300,000 and then minus also the interest payment of 100,000 equals 700,000 times 1.10 and we have 770,000 at the end of year 2. Okay? Minus 400,000 principal payment and 70,000 interest payment and we have 300,000 as the remaining balance at the end of year 2 times, for the last time, 1.10 and we have 330,000 minus 300,000 last principal payment and 30,000 last interest payment, and we have zero. Okay? So that's how easy the measurement of this interest bearing note. Okay? Now, how about recording? Let's talk about that after this. So now, on the recording side, in the beginning of year one, you just have to debit flying car or any applicable accounting title for 1 million, of course. And then credit notes payable 1 million. So that's how easy the initial entry is. So at the end of the year, that's still easy. Debit interest expense 100,000 and also debit notes payable for the decrease of the carrying amount from this 1 million to this 700,000. So the difference is 300,000. So we need to debit that to notes payable. And of course, we have to credit cash for 400,000. So that's the entry for the end of year one. Now, you have an option to record the principal payment and the interest payment separately. Like you can have the first entry, debit interest expense 100,000 and credit cash 100,000 for the interest payment. And you can also have the second entry at debit notes payable 300,000 and credit cash, of course, for 300,000. So it's up to you if you wanted to merge like this, or you can separate them. So the substance will still be the same. Okay? So moving forward. Now, at the end of the second year, the entry is very similar to this. Debit interest expense, but now it's only 70,000 only. Okay? And another debit for notes payable, which is 400,000, which is again the decrease from here to here. And of course, credit cash 470,000. And lastly, debit interest expense for the third year. But this time, we only have 30,000. And another debit for notes payable, which is 300,000. Because from here, from 300,000, it became zero already here. Okay? And then also credit cash 330,000. And that's it. That's how easy the recording and the measuring process of the notes payable, which is interest bearing. But there is a twist. The twist is, what if the illustrative problem included a cash price of this flying car? And for example, that is 983,116. So meaning, if you pay for it for cash, you're gonna pay this. If you're not going to pay it, you're going to pay it in installments. By using the promissory note, you have to pay like this. So the question is, what will happen? Let's talk about that in the next episode. So if you've learned, please click like, subscribe, and hit the notification bell to be updated on my next videos. So again, thank you for watching and see you on my next one.